What if I told you that the biggest reason most people fail at investing has nothing to do with intelligence, education, or even money? What if the real problem is the way they think? Most people look at wealthy investors and say one word. They say, he was lucky. She was in the right place at the right time. They bought the right stock. They got in early. And yes, luck exists. Sometimes someone wins the lottery. Sometimes someone buys a stock that explodes. Sometimes someone buys property in the perfect neighborhood before it becomes trendy. But let me tell you something that may sting a little. Luck does not create long-term financial freedom. Luck might create a spike. Luck might create a moment. But only principles create lasting prosperity. I have seen people make money fast. I have also seen them lose it even faster. And here is the uncomfortable truth. There are no shortcuts. There are no secret buttons. There is no magic stock that only the rich know about. There are patterns. There are rules. There are principles. And the people who win over decades follow them relentlessly. They do not follow the crowd. They do not chase noise. They do not panic when headlines scream. They think differently. They act differently. And today, I want to give you 4 key principles that can completely change the way you invest your money. These are not flashy tricks. They are not hype-driven strategies. They are foundational pillars. And if you truly understand them, you will never look at investing the same way again. Let's start with the first principle. Never lose money. I can already hear you. That sounds obvious, or maybe even boring. Most people ask a completely different question. They ask, how can I make more money? How can I double my returns? How can I find the next big opportunity? But the best investors in the world obsess over a different question. How can I avoid losing money? That single shift in thinking changes everything. Let me show you why. Imagine you have $100,000. Through a bad investment, you lose 50%. Now you have $50,000. Simple math so far. Here's the real question. What percentage return do you need to get back to 100,000? Many people instinctively say 50%. If I lost 50%, I just need to gain 50%. But that is completely wrong. A 50% gain on $50,000 is only $25,000. That puts you at $75,000. You are still $25,000 short. To recover from a 50% loss, you need a 100% gain. You have to double your remaining money. And doubling money is not easy. It can take years, sometimes a decade. This is why avoiding losses is more important than chasing gains. Because the deeper you fall, the harder it is to climb back up. Think about that. A 10% loss requires an 11% gain to recover. A 20% loss requires a 25% gain. A 50% loss requires a 100% gain. The math becomes brutal very quickly. So when Warren Buffett says, rule number 1 is never lose money, and rule number 2 is never forget rule number 1, he is not being cute. He is being mathematical. So how do you actually apply this? First, accept that markets are unpredictable. No one knows what will happen tomorrow. Not the analysts on television, not the influencers online, not even the so-called experts. Anything can happen. And because anything can happen, protection must come first. That means setting boundaries. That means not betting everything on one idea. That means using risk management tools. If you invest in stocks, you can use stop-loss orders to automatically exit when a position drops too far. If you invest in real estate, you protect yourself with proper insurance and careful tenant screening. If you invest in business, you maintain cash reserves. You create safety nets. You do not assume things will always go up, because they will not. There will be crashes, there will be recessions, there will be moments of panic. And here is something that separates amateurs from professionals. When markets are booming, amateurs feel invincible. Professionals feel cautious. When markets are crashing, amateurs feel terrified. Professionals feel alert. Because professionals know that survival is the first victory. If you stay in the game long enough, opportunities will come. But if you wipe yourself out chasing fast gains, you are finished. Your first job as an investor is not to get rich. It is to survive. Now, let's move to the second principle. Seek asymmetric risk and reward. This one is powerful. Most people believe a myth. They believe that to make big money, you must take big risks. They believe risk and reward are directly proportional. But experienced investors look for something different. They look for situations where the potential reward is much larger than the potential risk. Let me give you an everyday example. Imagine someone drives extremely fast to save 5 minutes on their commute. What are they risking? Their life, other people's lives, massive financial damage, legal consequences. And what are they gaining? 5 minutes. That is a terrible trade. That is asymmetric risk in the wrong direction. Huge downside, tiny upside. Now flip it. Imagine you invest in a strong company during a major market crash. Everyone is scared. Prices are down 30 or 40%. The company still has solid fundamentals, strong cash flow, a durable business model. What is your downside? Maybe it drops another 10%, maybe 15%. But what is your upside over the next 5 to 10 years? It could double. That is asymmetric in your favor. Limited downside, significant upside. Great investors love these setups. They do not chase assets when they are at all-time highs and everyone is euphoric. They become cautious when the crowd becomes greedy. And they become interested when the crowd becomes fearful. This requires emotional discipline because it feels uncomfortable. When markets are crashing, buying feels wrong. When everyone around you is excited about a trending stock, staying away feels foolish. But remember this, by the time you hear about a hot opportunity everywhere, professionals have often already positioned themselves, and sometimes they are already preparing to exit. Another part of asymmetric thinking is this: cut losses quickly, let profits run. Beginners often do the opposite. They panic and sell at the first small gain. They feel relief. They lock it in. But when a position goes negative, they hold on. They hope. They pray. They refuse to admit they were wrong. So they let small losses become big losses. Professionals reverse this behavior. If an investment thesis is broken, they exit. If a position is working, they give it room to grow. They think in terms of ratios. If I am risking $1, can I reasonably make 3? If the potential reward is not significantly greater than the risk, they pass. Not every opportunity is worth taking. Patience is a strategy. Doing nothing is often the best move. Now, let's talk about the third principle. Focus on net returns, not gross returns. This one is massively underestimated. People love to talk about returns before taxes. They love to say, I made 10%, I made 15%. But what really matters is what you keep, not what you make. What you keep. Let me give you a simple scenario. Imagine 2 investments. Both require the same amount of capital. The first generates $1,000 per month before taxes. The second generates $900 per month before taxes. Most people immediately choose the first. It looks better, it pays more, but what if the first is taxed at a much higher rate? What if after taxes, you keep only $700, and the second, because of tax advantages, allows you to keep $800? Suddenly, the lower gross return is actually the better investment. Taxes matter. Fees matter. Hidden costs matter. If you ignore them, you are lying to yourself about performance. This is why smart investors study the tax structure of their country. They understand capital gains. They understand dividend taxation. They understand deductions. They structure their investments intelligently, and sometimes the difference between average and exceptional wealth is not higher returns. It is smarter retention. You do not need to be a tax expert, but you do need awareness. And often, hiring a competent tax advisor is not an expense, it is an investment, because a good advisor can save you far more than they cost. Another hidden factor is fees, management fees, transaction costs, commissions. They seem small, 1% here, 0.5% there, but over 20 years, those percentages compound against you. Imagine two investors earning the same gross return. One pays 2% in annual fees. The other pays 0.5%. After 20 or 30 years, the difference in their final wealth can be enormous. Compounding works both ways. It can build your fortune, or it can slowly drain it. So always ask, what is my net return after taxes and fees? Because that number tells the truth. Now we arrive at the fourth principle, diversification. You have heard it before. Do not put all your eggs in one basket, but not easy. There is a massive difference between knowing this and actually doing it. Diversification works on multiple levels. First, diversify across asset classes. Do not put everything in stocks. Do not put everything in real estate. Do not put everything in crypto. Different asset classes behave differently in different economic environments. When stocks struggle, commodities might rise. When one country faces recession, another might be growing. Second, diversify within asset classes. If you invest in stocks, do not put everything into one company. Even great companies can fall. Even giants can make mistakes. Spread your exposure. If you invest in real estate, do not rely on a single property if you can avoid it. If that one asset underperforms, your entire income suffers. Third, diversify geographically and across currencies. We live in a global economy. Limiting yourself to one country increases risk. Political changes, regulatory shifts, economic downturns, currency devaluation, all of these can hurt concentrated portfolios. By spreading investments across regions, you reduce dependence on one system. Fourth, diversify across time. Not every investment must be short-term. Not every investment must be long-term. Some capital can be allocated for quick opportunities, some for medium-term growth, some for decades. Time diversification smooths volatility. Now, here's something deeper about diversification. It protects you from yourself. Yes, from yourself. We all have biases. If your family made money in real estate, you may believe real estate is the only safe investment. If you had a big win in technology stocks, you may become emotionally attached to that sector. If you believe strongly in gold, you might overallocate to it. But the world changes. Industries rise and fall. Technologies evolve. Regulations shift. What worked perfectly for 10 years may struggle in the next 10. Diversification is humility in action. It is an admission that you do not know everything. And that is powerful, because overconfidence has destroyed more fortunes than ignorance ever did. Now, let me bring everything together. Avoid losses, focus on net returns, diversify intelligently. Notice something. None of these principles require secret knowledge. None of them require insider information. None of them require millions to start. They require discipline. They require patience. They require emotional control. And that is why so few people follow them consistently. Because the real battle in investing is not against the market. It is against your impulses. It is against fear. It is against ego. Think about lottery winners. Many receive life-changing sums of money. And within a few years, many are broke, because money without principles disappears. Income without strategy evaporates. Wealth is not built by accident. It is built by repetition, by applying the same solid rules year after year, by thinking long-term in a short-term world, by staying calm when others panic, by staying cautious when others celebrate. Financial freedom is not a moment. It is a process, and it begins with how you think. So let me ask you something. Are you investing based on excitement or based on principles? Are you chasing headlines or building foundations? Are you trying to get rich quickly or trying to get rich permanently? Because those are very different paths. If you focus on protecting your capital, you stay in the game. If you seek asymmetric opportunities, you tilt probabilities in your favor. If you optimize for net returns, you respect the power of compounding. If you diversify wisely, you reduce catastrophic risk. And when you combine all four, something remarkable happens. Your financial life becomes more stable, more predictable, more resilient. You stop reacting emotionally to every market swing. You start thinking strategically. You start seeing downturns as potential opportunities instead of disasters. You start measuring success in decades, not days. And that mindset shift is everything. Remember this? You do not need to be the smartest person in the room to win at investing. You need to be the most disciplined. You need to avoid the big mistakes. You need to survive the storms. You need to think in probabilities, not certainties. The market does not reward excitement. It rewards patience. It does not reward noise. It rewards consistency. So here is your challenge. Take these 4 principles and examine your current strategy. Where are you exposed to unnecessary losses? Where are you accepting poor risk-to-reward trades? Where are taxes and fees silently eating your gains? Where are you overconcentrated? Be honest, because the market eventually exposes dishonesty, not to punish you, but to teach you. And the lessons can be expensive, or you can learn them in advance. The choice is yours. In the end, investing wisely is not about predicting the future. It is about preparing for it. It is about building systems that work across different scenarios. It is about accepting uncertainty while protecting yourself from ruin. That is how real prosperity is built, deliberately, intelligently. So do not chase luck. Build principles. Do not follow the herd. Build your strategy. Do not gamble with your future. Protect it, because financial freedom is possible, but only for those who respect the rules of the game. And now, the question becomes simple. Will you be reactive, or will you be strategic? Will you drift with the crowd, or will you think independently? Your money will follow your mindset. Choose wisely, and start building not just wealth, but lasting prosperity.